Okay, so we went through and talked about the four different factors that of information that we need in order to depreciate for tax purposes. So we've got our basis. We've got to establish what our basis is in the property. We've got to establish what our asset class life is, and that's determined for us by the IRS. They give us the list of different types of assets, and they say how long you're going to depreciate them over. Then we've got our convention that we have to determine, and that is kind of the more complex part, the part that is a little bit foreign to those who are just getting introduced to tax depreciation. Those conventions, remember, we have the half-year convention, we have the mid-month convention, we have the mid-quarter convention, and which convention we use is determined by whether or not we are depreciating real property, or which would be real estate, anything other than land, real property or personal property. Not to be confused with personal use property. Personal use property is everything that's just yours personally, your personal car. You're not using it in a business. So we need to determine what type of property it is, and then if it's real property, then we're going to use that mid-month convention for depreciation. If it's personal property, whether we use the mid-quarter convention or the half-year convention depends upon how much property we placed in service in the last quarter of the year. Remember, if it's more than 40% of our personal property was placed in service during the last quarter of the year, then we have to use the mid-quarter convention. Otherwise, we can use the half-year convention. And recall, those conventions have to do with when we start in that first year, when we start to depreciate an asset, and in that last year when we stop depreciating an asset. And we have to stick with the same convention throughout the life of that particular asset. We looked at the tables that we use to determine what our depreciation percentages are, and then we also talked about that fourth factor, which is the method that's used. And again, that method is built into the tables, right? We've really only got three different methods that we can use. We can use 150% declining balance, 200% declining balance, or straight line depreciation. And again, the IRS just kind of determines what method we're going to use. We can always choose to use straight line depreciation if we want to for a particular asset. We can make that. You have to make a special election in order to do that. In most cases, the accelerated or that declining balance depreciation is going to give us more of a depreciation deduction up front, and most businesses will prefer to have as much depreciation deduction up front as they can. So just kind of a little recap of how that depreciation works using those four factors. We are going to talk about some special deductions that can be taken that help, again, to accelerate the depreciation that we take. Now, for financial accounting purposes, we really don't want to accelerate our depreciation because we want as little expense as possible, right? We want our net income to be as high as possible for financial accounting purposes, but for tax purposes, we'd really like that net income to be as low as possible because that's then going to lower the amount of tax that we pay. There are a couple of accelerated depreciation methods that we can use that help to increase that expense. The first one is called Section 179 expense election. You hear this term a lot when you work in tax, Section 179. It's a 179 deduction. So that refers to the code section that within which this election is described. And what it allows you to do, if you elect to take the 179 expense, what you can do is you can write off a big chunk of your asset purchases immediately. Now, it's not unlimited, There are limits to it. And that's what this table here is showing. So the maximum amount of Section 179 expense that you can take in 2024, you can see these amounts change every year. They're slowly going up. In 2024 was $1,220,000 of expense selection, which means that if you had, and by the way, this applies to personal property. So we're not talking about real property here. There is an exception to that, but for right now, let's just talk about this is for personal property, meaning, so if we had personal property purchases in 2024 of $2 million, we cannot elect to take the full 179 deduction on all 2 million of that, but we can elect to take the 179 expense on 1.220 section. No, that's not a $sign, Kelly. Just a section. This is like the abbreviation for section. So section 179, we can take that amount of expense, and we get to take that expense right now then. Immediately. We can take that. 1.220, which means the rest of it, then we're going to depreciate using that method that we learned about earlier in this chapter. The regular, we look at those 4 components. So whatever is remaining, what is this? 80. What do we have? Is it 780? $780,000. We're going to depreciate depending upon what, which asset class life we're using, which method we have to use. The rest of it, we're going to depreciate using that method that we learned about last Thursday. So, but we get to take an immediate write-off of this amount. Now we're limited as to how much we can take in an immediate write-off just by the amount of assets that we purchase, but we have an additional limitation based on the total personal property that we placed in service during the year. So what happens is this expense election is phased out dollar for dollar for any purchases in excess of $3,050,000. That number changes every year. That's why it's kind of an odd number. It's indexed for inflation. So if we had, the first thing you'd want to do is say, okay, what were our total personal property purchases? And if it was more than 3 million, so let's just say it was $4 million. This is, we total up all the personal property that we placed in service during the year. Then what we have to do is, what do we call this here? It's not really, this is our first limit. We're going to take 3050. So this is once we reach this 3,050,000, that amount of purchases, we start to limit this amount. That starts to get reduced. So we subtract this, what do we have? 950,000. So now this is our reduction in this amount here. Whoops. So what do we have? 111, 270. Now this is our 179 limit. So there are 2 limits. There's a limit based on how much total personal property we purchased during the year. We have to reduce our total 179 limit by how much by this amount. to get our first reduction. And then we take that reduction, this is our reduced amount, we subtract it from that maximum 179 deduction. So this is a deduction limit, and this is a purchase limit. So there are two steps to that process. Let me see if we've got an example here. A couple of things I want to mention before we go to the example. So the 179 expense, so the property, again, has to be personal property, has to be used in an active trade or business. So it's not for like your personal house. We're not depreciating our personal house anyway. And not for investment property. Also, you can't use it for rental property. Okay, so it doesn't apply to rental property. So this is an active trade or business. Rental properties are considered to be passive types. There are certain ways that it can be active, and we'll get to that when we get to chapter 8 a little bit more. But for our purposes right now, the vast majority of rental income is considered to be passive income, and so the 179 only applies to active trades or business. So that's why it's not included there. It cannot create a net operating loss, which is something, again, we're going to talk more about that in chapter 15. Net operating losses, this is where your expenses exceed your income and you have a negative number. Some special things happen when you have a net operating loss. You get to carry forward some of that to future years. But the 179 cannot create a net operating loss. So in this case, if we had an allowable 179 deduction that we could take of $270,000, if our income was $200,000, we would not be able to take that full $270,000. We could only take $200,000 of it. So that's what they mean here. It cannot create a net operating loss. You do actually have, okay, I'm getting ahead of myself. I want to look at, maybe on Thursday, have some time to look at the tax return problem that you're going to have for chapter 6, because some of this, what they talk about here, is integrated into that tax return problem, and it can be a little bit tricky. So any of that 179 expense that is disallowed by the lack of business income can be carried forward forever. So it can absorb future business income. Also, you can't acquire the property from a related party or by gift or inheritance. You have to purchase it, right? It can be acquired with a trade-in, but then if it's acquired with a trade-in, the limit on that is the amount of cash that you actually paid for it. So any that trade-in amount that you're getting, what you're trading in, the value of that doesn't apply. So it's only the amount of cash that you actually spend on the purchase. So here is an example. ABC Company purchased $1,291,000 of total personal property in 2024. So the first thing that would be this amount. They can elect, and here, let's see. So the total personal property that they purchased, $1.29 million, is well below this $3,050,000. So they don't have to do this first part of this calculation. You're really only going to do this calculation if the total purchases during the year, personal property purchases, was over that amount. So the first thing you do is say, okay, well, were our total personal property purchases more than $3,050,000? In this case, no, they weren't, right? It was $1,291,000 of total purchases. So we don't have this limit that we have to take into account. So we can go over here. So our total limit is now the $1,220,000. So they're going to have this $71,000 that they'll then carry over Well, they can either carry it over, or they can, normally what you do is the rest of it would be using maker's depreciation. So they would apply our depreciation that we talked about earlier. That's what we would use to depreciate the $71,000. Okay, so there are kind of two components to that. And you can pick and choose which assets you want to apply the 179 to. So if you, and you can choose not to use it. So you can use an amount that's less than the 1,220,000. So you can choose to, maybe even though you purchased $2 million in purchases. Well, this is below the $3,050,000, so we don't have to deal with this limit, but we're still limited in total to our deduction of 1,220,000, but we can choose to just take 1 million. 179. Then we'll have another million that we'll depreciate using makers. So we can do that. We just can't exceed 1,220,000 in 2024. We cannot elect more than that amount. Questions about 179? So, let me see if I've got another example here. So they talk about here certain real property. If it's non-residential real property, if it's an improvement. So qualified real property would include improvements to non-residential real property, such as roofs, HVAC, fire alarm systems. These properties are subject to the same 179 limits, but it's all non-residential, so you still can't use it. It still can't apply to residential, which is what apartments and that's what the rental properties would be. All right, so that's the 179 deduction. It allows accelerated depreciation on certain types of property up to certain limits. Okay, and those limits, we've got two limits. One is based on the personal property. We have a purchases limit, and we have a deduction limit. Okay. Questions? All right, we're going to go to another